It happens.
I was like, oh, that's kind of tricky. Thanks so much for rescheduling this. I'm so glad to be here. Snow didn't really help us last week, did it?
Well, one thing I found out is there are no simple questions at Indy Hall. So far, I've yet to get one person that just says, "Hi, I'm filing my taxes, and what's the Social Security rate?" That's my book.
How are you, Alex?
I'm good.
Awesome. So whenever you're ready, we're recording.
Okay.
You have folks. I can't see if there. I think there's some people online.
Okay, ready?
Yeah.
Okay. Hi, my name is Jose Nieto. I work with, well, I own Lanyap Financial Services. We are an accounting firm. We're not a CPA firm in doing traditional audit functions. What we do is we help small businesses. Our primary business are small businesses, startups, nonprofit organizations. And what we do is we help you navigate all the apps that are out there to help you use something like Bill.com and use QuickBooks and use a web server and allow you to do all your accounting on the web, which is traditionally what millennials like to do. Older people don't trust the web and they're a little bit more hesitant about using it. My expertise is taxes. I've been doing taxes for about 45 years. And so I've gotten a lot of questions from people regarding types of entities, what an LLC is, what the new tax rates are, et cetera. So I'll start with essentially what an LLC is. An LLC is just a limited liability company. For taxes, it doesn't exist. An LLC is one of four things. Most people think of it as a disregarded entity, which is a Schedule C. You just file it on your taxes. It's pretty simple. If you have one or more people, you can be a partnership, and that's called 1065, and that's a separate tax filing. If you want to be a corporation, there's two types of corporations. One, which is the standard corporation, which is an 1120, and that's the type of entity a lot of startups are, which they issue stock, and people invest in your company, and they buy additional shares of stock. And then there's something called an 1120S, which is becoming very popular today because it is called a pass-through entity. And basically, the income of the company passes through to your tax return on what's called the K-1. So both a partnership and an 1120S give you something called the K-1, and it makes your tax return fairly simple. It's a one-line income line item. And your tax return, if the company gets audited, your personal tax return doesn't get audited. If you're a disregarded entity, all your income and expenses are available for the IRS auditor to review, and at the same time, he's going to review your itemized deductions, your W-2 or whatever. And so LLCs are really the organization that everybody loves to use. There's a lot of questions on that. The other question I have is basically the new tax brackets, and essentially the tax brackets give you a small amount of money. They say you're making $75,000, $80,000, you're saving $11 a week. And if you're making over $500,000, you're making you're making a killing on the tax rates and a lot of the other aspects. But for most people, it's a small savings. It's nothing that you do a lot of serious tax planning over. It's nice, but you know, there's a whole political discussion about, you know, cost benefit of those savings. But in Slack, I've attached both of these documents. So if anybody wants to see the new tax rates that are available in Slack, and the four possibilities of an LLC are also, it's a document that details it out a little bit greater. But mainly I want this to be a question and answer because I don't really know where people are coming from. So I open it up for anybody that has a question pretty much on anything. If it gets too complicated and too specific, I'll talk to you afterwards on it. But if it looks like more than one person is involved in it, I'll try to discuss it. I may not know everything about everything, but I'll try. Go ahead.
So I've been talking with my tax accountant, and I
kind of already explained the whole situation, but when I asked her what should I do for next year in terms of doing some kind of registration, she said that I wouldn't really get much benefit out of being an LLC, but that I might out of being an S corp. And she won't go into detail with me until after she's finished with the tax season and later in April. But like, what is that?
Okay.
What does that
So
mean?
a corporation, as Mitt Romney indicated, is an individual as far as the IRS is concerned. It's considered what's called an entity. So it has its own profit and loss statement, and you have your own profit and loss statement. So currently, let's say you make $100,000. You make $100,000, you pick up $100,000 worth of income on your Schedule C, and then you pay income tax on that. And you pay Social Security, both the employer and the employee portion, which is 15.1%, and you pay that on your tax return. So let's say that you feel that your salary should be around $75,000, which is what you could earn as a minimal amount of money. So you could give yourself, you could create an LLC, choose to make a sub-S election, and choose to become an 1120S. An 1120S is considered a pass-through entity. So that income passes through to you after deductions. You register for a W-2 and you pay yourself $75,000 of salary. Your company earns $100,000, it deducts $75,000 of salary, it has net income of $25,000. On your personal return, on the first example, you paid on $100,000 and you paid Social Security on $100,000. In this example, you pay on $75,000 worth of salary and $25,000 worth of pass-through income. Same $100,000. The exception is when you take the $75,000 worth of salary, half of the Social Security is paid by the company, half of the Social Security is paid by you as an individual withholding. The remaining $25,000 is not subject to self-employment tax. So you save 15% on that $25,000. And so that's really where the savings is. Now, a lot of people used to try to take that argument and say, I'll pay myself $5,000 and report the $95,000 as pass-through income. And the IRS took the position that that's a scam and you're just trying to get us on a scam, and we're going to audit your return and hit you for everything you can. So they have what's called the reasonable salary. What would you pay somebody else if it wasn't you? What would you pay them? So if you had to hire somebody to take your position and you had to pay them between $50,000 and $75,000, you can't pay yourself less than that $50,000 or $75,000. It's called reasonable salary, and they take that into position and they look at industry standards and what other businesses generate at this particular point. The big area of abuse was like on doctors and dentists. They would show a $25,000 salary and they would show $250,000 worth of sub-S income, and they'd say, you're paying your receptionist $35,000. How can you pay yourself $25,000? But the main thing is, an 1120S is not subject to self-employment tax. The other thing you've heard about is the new tax laws say pass-through entities pay at a lower tax rate at 20%. The problem is, the thing they didn't tell you is most professional services are exempted from that lower rate. So accountants, lawyers, Indian chiefs, engineers, computer people are pretty well exempted through statute that personal services don't qualify. And then they have a whole lot of other layers that if you do qualify, you're limited to how much you can take. 50% of your W-2 qualifies as that. So if you have $50,000 worth of income, only 25 qualifies at the lower rate. And for a tax simplification thing, they've added another 300 pages of documentation on it. So it's by no means simpler. It's much more complicated. And I'm not up to speed because I haven't taken enough seminars, and I'm doing it after tax season, so to catch up on what needs to be done for 2018.
So these benefits are not for small business.
No, they're intended. Basically, if you make $500,000 or more, you are on having a great time. It's a wonderful thing for you. You can just create an entity and just have all your money go through that entity and you'll make money.
So following up on the S corp question? What is the line where I want to think about reorg? I'm currently an LLC. Like when do you? Is it that you pass the revenue number of what a reasonable salary would be, so then it starts to make like?
Well, basically, I mean, an S corp allows you to pay yourself a W-2. As far as I'm concerned, it simplifies your life. I was a Schedule C for many years, and I took on my son as a partner, and we became a partnership. And then he asked the same questions, and it's like, oh, okay. You know, the shoemaker's kids always have holes in their shoes. I was like, we probably should be a sub S corp and, you know, pay ourselves a reasonable salary. And for me, it simplified my personal life where I got a paycheck every week, whether I had to put money back in the company or not, depending on the flows of the organization. I still got a revenue number every week, and it made things a lot simpler on my personal tax return because I had two line items, a W-2 and a K-1. While before, I used to just wait 2 months till I got paid and then pay 2 months worth of bills, and then all the money would disappear. So my personal life didn't really get the time and attention that my business got. And this way, I just have things on automatic on my personal life, and I can spend all my time dealing with my business finances. And it makes life a little simpler for me. That's really the main thing. There's no magic number for switching over from one type of entity. The main thing is really the W-2. I like the W-2 aspect. You can get something like Gusto, which is like $35 a month, and you can pay yourself the W-2. It does all your taxes for you. You don't have to file estimated taxes, which you need to do as a self-employed individual. I think it just makes your life a lot simpler. You don't have to pay attention to taxes, and you can pay attention to making your business a better business.
And the only real disadvantage to being an S corp is that you have to do a corporate tax return.
So you have to do a corporate tax return. You got to pay me extra money,
right? Yeah.
Because you might pay me, like my flat fee is $350. I might charge you $150 more for your business. If you do a corporation, I have a minimum number for a corporation that is based upon a large corporation. Your corporation might have 10 line items, and you're stuck with a minimum of somewhere between $500 and $1,000 for a corporate tax return, depending on who you go with. Because there's just so many more rules and questions. And then if you have foreign investors or people from Canada or any other state involved in your corporation, that brings a whole new level of complexity to things where if you have a foreign bank account, if you have foreign investors, if you have foreign owners, all those things, a corporation can handle them, but that's why I charge, because every time someone tells me they have a simple $350,000 gross company, I said, oh, okay, that's pretty simple. I should be able to finish that in 2 minutes. And, you know, we talk about it for a half hour, and they explain to me all the complexities. And that's really, you know, what comes into play, all the other add-ons.
To do that, to be an S corp, do you have to have relatively predictable income?
No, you can have any type of income. What you have to have is you're limited to a certain number of shareholders. You cannot have foreign shareholders. You can't have certain kinds of corporations. You have to have people as your main shareholders. But you could have other sub-S corporations. There's something called the sub-SQ, and you can have subsidiaries that are sub-S corps. And they roll up into one tax return, but you have to file something called the sub-SQ subsidiary election to roll the numbers up, et cetera. So, but yeah, as long as you don't really get too complicated. If you're a startup and you're looking to get people to invest in you, you know, for either friends and family or something, or Series A or anything like that, you really need to be a corporation and have shares of stocks authorized, et cetera. But one of the other questions a lot of people ask is, what advantage is there to be a Delaware corporation? And I found that Delaware corporations are oversold. If you're a Delaware corporation and you do all your business in Pennsylvania, you file a Pennsylvania tax return. You pay taxes to Pennsylvania. You pay gross receipts to Pennsylvania, and you pay a franchise tax to Delaware. if you make no money on that corporation, you pay no money to Pennsylvania, and you pay a franchise tax to Delaware. And that tax is typically anywhere between $200 to $1,000, depending on number of shares you have, amount of equity, et cetera. So if you're a Delaware Corp and you're starting a credit card company and you're doing business all over the United States, and you're doing business in all 50 states, that's a different story where the corporation is an entity and it pays taxes based upon its domicile, which is Delaware. But there's lots of fees associated with these simplification things that they have.
If there's no intention to be raising funds or bringing on partners, and I want to, start or run a business that's basically me and occasionally subcontractors and things like that, does an S corp still sounds like there's advantages in terms of, like you were saying, simplification? Like you can still be a solo operator as an S corp, and just means that once everything is sort of in place,
it's more of it's more administration fees than anything. Okay. It allows you, if you're an individual, you could form a 401k or do what's called the SEP, which is a simplified employee plan, on which you can put aside money for you and your employees. So all these advantages are available on whatever type of entity you have. They just call them 401k, 401b if you're a nonprofit, a SEP, an IRA, et cetera. But I also find that ADP oversells their 401ks to small businesses, where if you have a 401k, you have to file 5500, which ADP says they will file for you at a low fee of, and then if you forget to file it or they send you a form, and I've had that happen with 2 companies already, and they've just been inundated with emails and they didn't bother reading the email from ADP, they just deleted it, and it said you have to just check off and sign it and they will mail the form for you. They don't tell you that you didn't mail the form, and then for every day you're late on a 5500, they charge you $25. And so I have a one-person sub-S corp, a one-person corporation that put aside $5,000 into his 401k that he doesn't really want to have anymore, and he just got a bill for $8,750 for a late fee. That ADP will sit there and file for you if it's the first time, but a lot of times I find out about it after it's 2 or 3 years late, and there's continuous fines of $8,750 because they don't stop. They just continue to run. And it's really mind-boggling some of the penalties they can charge you for organizations that have no taxes. They just charge you a per-day fee, and that kind of clock can really run up.
What is ADP?
ADP is just a payroll processing service. Gusto is if you're looking to do a W-2, I would highly recommend you not do it yourself. And I'm a QuickBooks Pro advisor, which means I'm supposed to be an advocate for QuickBooks, but I would recommend you not use QuickBooks for payroll either. Use an outside payroll service. If you're big, you use ADP. If you're not so big, you use Paychecks. If you're small, you use Gusto. And what it means is ADP might charge you $50, Paychecks may charge you $25, and Gusto will charge you $30. But ADP and Gusto will charge you that per pay period. So if you have 4 pay periods, you're only paying $40 a pay period, which, if you look at it for the year, adds up when all you have is a $50,000 W-2.
And this is versus writing out the checks yourself and handing them to.
No, that's versus you writing a check out to yourself, writing a check to the IRS, writing a check to the state, writing a check to the city, writing a check for PAUC, writing a check for FUC, then writing W-2s at the end of the year for all those various entities and making sure you're never late. Okay. And getting a 5% penalty for being 1 day late on any of them. The aggravation is just really not worth it. In fact,
walk you through all of this.
I refuse to do a manual payroll.
Also have your quarterly returns.
And your quarterly tax return. This is Walter, he's one of my clients. Yes, and you have to file quarterly tax returns, which if you're late, you get penalties on them. So in the old days, we used to do them by hand, and I just refuse to do anybody, even if they come to me in December. I'll try to put them on Paychex or ADP, just to type the W-2s, because you can't even find the forms anymore. You go to Staples and you got to find some software, and you got to, got to register with the software company. It takes you an hour or two. It's just not worth it. Just it's too simple with all these third-party services. And if you're a one-person company, a lot of these companies have special rates for single employee services, because they realize that it should only charge you so much, and you can just do a monthly payroll or something like that, which makes it a lot simpler and a lot cheaper.
That's triggered a question I've had about 1099s.
Yes.
And actually, I'm kind of both sides. So I'm a single person LLC that also has a couple subcontractors that I pay regularly. So one question is, this year I just ordered the forms from, this is the first time I've ever had people that I think qualify for 1099s. I just ordered the forms from the IRS and hand wrote them. Right. There's got to be a better way to do that, right?
Right.
Need servers or something.
That QuickBooks actually does a nice job on.
Does it? Because I use a QuickBooks.
QuickBooks.
I use QuickBooks Self-Employed. Which is
Okay. Well, QuickBooks has a click on when you register the company. It says, are they qualified for 1099? Are they qualified? So they look to see consultant. The consultants all qualify for a 1099 miscellaneous. Yeah. Then it asks, do you have a tax ID number for them, and then an address for them. So it'll print it on a plain piece of paper.
Okay, I guess, yeah. All right.
And then you can go to Staples and buy the papers, and you can, if you have three 1099s, you do 3 1099s, and then you do a W-3 for the 3 1099s.
That's the thing I sent the IRS.
That's the thing to the IRS. The IRS will not accept handwritten W-3s.
Oh, I sent them a handwritten W-3.
I know, but they may come back and complain. They may come back and complain to you.
Really? Okay.
Yeah. So they really don't like. Yeah. In fact, if you have over a certain number, they want you to do it electronically. Yeah. The other thing you can do is you can register to 1099s.com, one of these things, and you can type them on there, and then you go to Staples and buy the forms. Yeah. Or sometimes they're pre-written, and they'll charge you $5 a 1099, and they'll do the electronic filing for you on the W-3. QuickBooks does electronic filing for the W-3s, and then you have to do the same type of thing. So there's a lot of ways to get the 1099s, but the hardest thing is, who do you give a 1099 to?
Right.
And the state and the feds are all coming at you where before they didn't give you their social security number, so you didn't give them a 1099. So now the government has put the responsibility back on the employer. Do you have people you're supposed to give 1099s to, and did you give them to them?
Right.
And so what they're getting you on is the lie. So on their audit, if you were supposed to have given 1099s, now they can say not only did you not give 1099s, which are only $25 a fine, but you lied to us, which then they're going to try to put additional pressure on you.
Right.
So they're really going after people with 1099 miscellaneous for the underground economy. They're also going for what's called the 1099B, which is sales of stocks and bonds. Mm-hmm. And so they want to know that you sold $10,000 worth of stock. And if you don't report it, they're going to say you had $10,000 worth of profit and you had a cost basis of 0. Then it's up to you to prove that you actually had a cost basis and reduce your capital gain income. So all these forms, computers used to be 3-4 years behind. Now they're getting to be 1 or 2 years behind and catching up with all these documents. They receive everything. And they try to do a mix and match type situation. For yourself, if you get 1099s and you share them with somebody, let's say you receive a 1099 for $50,000 and you split it with your partner, but you're on the form. You have to report the $50,000. Then what I would do is show a reduction of $25,000 and show that person getting a 1099 from you. Because otherwise, they're going to say, you underreported your gross income, and we're going to hit you with an extra $25,000 of income. I've had that situation happen on stocks and bonds where they were on two brothers were on a joint account, and only one social security number was able to be reported. So we have to show it as a positive number and as a negative number, which really throws the tax software off. We show it as a negative line item. We show the ID number of the other person, and the other person we report it. So on their audit, we can show the activity going back and forth. It doesn't mean that you won't get audited. And just because you get a computerized record from the government doesn't mean you're being audited. It just means your computer has not reconciled your numbers. And so don't panic about it. Just hope you did it correctly.
Right.
And so you just respond to them. Please be advised that we're in disagreement with your letter dated such and such, and then give your case on why you think it's different. Or see your local tax advisor.
So as a single person LLC getting revenue from clients, should they be like, I have like one client who sent me a 1099.
Everybody should be sending you a 1099.
And if clients don't send me a 1099,
You
that's
still
not
have
my problem.
Well,
Right?
it's
I mean,
not.
I'm
it's-
reporting the
it's-
income.
Well, as long as you're reporting the income, it's not your problem.
Okay.
Okay, it's their problem. Technically, you should. Yeah, it's their problem. They should be reporting it. Somehow the government's going to try to make it your problem, but it's something that can be explained away via letters.
Right.
Just because you didn't. What I find interesting is somebody says, I can't file my taxes because you didn't give me a 1099. It's like, well, actually, you can file your taxes because you need to report all your income. Like I have one person, best client I have, he worked for the government. And so he retired on a great pension. And so he does unemployment audits for ADP and paychecks, you know. And what he showed is he had 15 1099s that totaled $32,000. He reported income of $35,000. And so what we do is we show the $32,000 on a separate line that says 1099s, and then we show $3,000 of additional, and it ties into his number. But you always want to make sure your 1099s are less than whatever you're reporting. If they're higher, then you need to figure out.
Right.
Like a lot of times, you may get a 1099 on a check that was written on December 30th, and you didn't receive it until January 15th.
Somebody else
I had that
quiet.
You're going to get screwed on that deal. Either you pick it up in the year that you received the 1099, or you have to sit there and do it as a minus, and it's really going to be cumbersome for you. So you basically take the hit. Most people just take the hit the first year, and they don't.
They just book it as they change the revenue. They booked it to the previous year.
Unless it's a substantial that it's worth the aggravation, and then you pick up the total income, and you show not received. Not received until January. But a lot of law firms used to play that game. They would receive a check on November 30th, and the thing didn't get deposited until January 5th.
Right.
So the IRS didn't like that for some reason, and so they look at form over substance. Form over substance, I guess. They look at the reality of the situation versus what you're doing. You can play all the games you want, but under audit, none of them work if you're really playing games.
Right.
Those guys are actually. I always tell people, once the IRS is asking questions, you've already lost. You're not going to win. They have much more resources available to them, and they've seen every trick in the book. So you're not smarter than them. And if you try to get smarter than them, then you're going to get caught in a lie, and then you're really going to hang yourself. So you absolutely never want to lie in an audit, because then they will press criminal charges against you. You don't mess with the IRS. But they're not as smart as you think they are sometimes. There's a lot of dumb mistakes that they make. And if you can prove your case, you can usually, if you have documentation, I have a guy that has a bag full of documentation. Just take it all there. Look, you're showing you have everything. You're showing you're trying, that you make a mistake somewhere is not a crime. But just making stuff up is a crime.
You were talking earlier about sub-SQ filing multiples LLCs
Right.
under one file tax thing. So if you have a few companies and they're all kind of a subsidiary of the original company, how does that work as far as separating the taxes and bank accounts and expenditures and stuff like that?
I would separate the bank accounts. I would separate the companies. You could set them up if you're using. I use QuickBooks. That's the sort of the standard.
Mm-hmm.
There's also, FreshBooks and, all kinds of other software types. But I use QuickBooks. It's sort of the standard. You can set them up as classes in which You have separate bank accounts for each company. You have separate EIN numbers for each company. So you can either, if you're really fancy, you can use QuickBooks Enterprise, which rolls everything up, but that's a very expensive accounting package. Or you can use classes in which you have separate bank accounts for each account. And so you can create a consolidated income statement and individual income statements. Okay. From an accounting perspective, you can use accounting packages to track everything separately and combined. And then you use that combined statement and create the 1120S for the parent company. You have to identify the other companies, and you have to file elections on the other companies showing the relationship of parent and sub.
How does that elections?
Yeah, they're just, that's really once you're getting into how the watch is made. It's fairly complicated, but you have to do a separate election showing that you want to do a Q election. I think it's a Q election.
What's that statement of an election? Like, what is
it says that I am a parent, I am a subsidiary of this parent. Here's the parent company. This is the subsidiary. This is who owns us. This is who owns that. There's common ownership, and it rolls up. Just like if you look at corporate taxes have a low tax rate on the first $25,000. And so somebody thinks that the corporate tax rate is 15%. The individual tax rate is 35%. Like, oh, why don't, instead of making $100,000, I just create 4 corporations making $25,000 each? Well, if you have common ownership, the IRS combines those ownerships and says you have to file a consolidated return, or you have to sit there and combine the rates in order to get your new rates. So that's what I'm saying. Once you start, you look at the individual laws and you try to get tricky with them. They've already seen those tricks, and there's usually some paragraph deep in the archives of the IRS code that take care of those types of problems.
So you're going to be like the Social Security income, you can split it between the companies separately.
Well, Social Security income, you could split between the companies, but in that situation, you would hurt yourself.
Right, because then you're paying more for.
Well, you
putting all in one.
pay half more.
Okay, yeah.
So let's say you make $200,000 and you're paying it out over 2 companies. You pay on $100,000 worth of Social Security income on company A and $100,000 worth of Social Security on company B for employer taxes. Then you get 2 W-2s showing you paid 100% on 100,000 and paid 100% on the second 100,000. On your personal return, you'll get a tax break. It's called excess Social Security. So they'll give you back the excess over 200,000 over whatever the maximum Social Security rate is on the Social Security portion of it, not the Medicare portion of it. Because the 15% is actually 12% Social Security or FICA and 3 point something for Medicare. So that's, but the personal tax return takes care of some of that. But in that situation, you would end up paying extra Social Security and you would get 0 benefit for it. It would actually cost you more money to split it between 2 corporations that way.
So if you just pull them all up in the one,
Yeah.
that
Just
legal
do one.
term, then you could.
One W-2, you'd stop paying Social Security at 128, whatever the number is today. You'd stop paying on that first portion, on the employer and the employee.
And this is all as long as they're an LLC of some.
That's tax law. That's partnership, LLC, 1120, it doesn't matter. Technically, if you're a Schedule C, you can't pay yourself a W-2, even though I've seen it. Technically, if you're a partnership, you can't pay W-2 to yourself. You're supposed to have partners draw. Yet I've seen it, that it's there. If the IRS would disallow the W-2, they'd have to give you, they'd have to give it back to you on the other side. It's just a matter of, it's more of a technical violation than you were trying to avoid taxes. You're still paying the same amount of taxes. You were just trying to make it convenient for yourself, and you didn't feel like filing a sub-S election.
Okay.
Now, the one thing about sub-S's are, if you don't file them on time, you get a penalty. If you don't owe any money on an 1120, which is corporation, you pay on a percentage of tax due. On a sub S corp, you pay a penalty of $75 per partner per month for the first 5 months. So you could end up just forgetting to file your 1120 election extension, which was March 15th. You file in June, and you find out later that you owe hundreds of dollars in penalties because you had 3 partners and you filed 4 months late. So the sub S, that's sort of what that's the extra money you pay for to sit there and keep track of all the extensions and et cetera. Partnerships are the same way. If you don't file a partnership extension, you get a penalty. There's an exception for partnerships with less than 10 partners, but they only give you a 1-year exception for it. So if you're 2 or 3 years late on it, they say, we gave you a 1-year exception. We're not going to give it to you for the 2nd and 3rd year. Because I used to have a standard letter that said, per revenue section 10-54, partnerships with less than 10 partners don't qualify. And they're like, yeah, but you did it last year. It's like, yeah, no, I do it every year. It's like, no, it doesn't work.
For extensions.
Yeah. No, for an exception to the penalty because they didn't file their extension, or you sent them the stuff and they forgot to mail it. Oh, yeah, I sort of had it in the pile and I didn't get around to doing it. I know I didn't know anything on it, so I didn't really care.
Yeah.
And, they come back to you.
What about the company I work for? We just ignored the IRS letters and the state letters and the city letters.
Walter is one of my quality clients with lots of additional problems.
And it went away. Not the government, the corporation.
Yes.
So now I'm unemployed.
Pay your taxes on time.
I'll see you later.
Take care. Thanks a lot.
So
Oh.
if your accountant doesn't file, you said there's a possibility that you could tell him, like, if he didn't file the extension or something like that, they give you a waiver sometimes, but it's only
They'll give you a one-time waiver.
Okay. And you
First
can
time
file an
waiver.
extension every year, no matter what.
Yeah, you can continue to
But then
file
there's
extension, but no.
$75 fee a month.
No, there's no, if you file an extension, that just means that you didn't file. There's 2 types of penalties. There's a failure to file penalty, and there's a failure to pay penalty. So let's say on your personal return, you owe $1,000. On April 15th, you can file an extension that will allow you till October 15th to file your return. The pay your return needs to be done on April 15th.
Okay.
Which I find fairly interesting because people give me their stuff on April 10th and they say, file an extension for me. But I say, I can't figure out how much you owe because you got to pay it on April when you file the extension. So you don't get an extension to pay, you just get an extension to file. So let's say you owe $1,000 and you don't extend and you don't pay. You pay a 5% penalty for not paying, and you pay a 5% penalty for not filing. So that $1,000 it just cost you $100 on April 16th.
Does it help to like prepay? Because I've been doing it the last few years. I have like some base.
I always tell people to,
I've always been paying quarterly, like what I've done just about the last year, and then when I file, finally, they're like, oh, you just owe us this, or we owe you
Right.
this much, and then they're like,
well, that's called estimated payments.
Yeah.
So let's say you owe $10,000 this year. You pay your $10,000. Next year, you know your income's going to triple. You only have to pay $10,000. It's something called the safe harbor. There's something else that's called an underestimated penalty. So even if you pay all your taxes on April 15th, they can penalize you 5% for each quarter that you underestimated what you were going to pay. So if you owed $40,000, they're saying you were $30,000 short. 1/4 of that was due on April 15th of last year before you even knew you owed it. But they say you need to sit there and come up with a quarterly income statement to calculate your taxes on April, June, September, and January. So you can get an underestimated tax penalty in addition to the non-filing penalty, in addition to the non-payment penalty.
So if you didn't find out between January and April that you actually owed more for the year before, they'll want you to pay by April
unless you got a safe harbor and you paid in at least as much this year as you paid last year. So if you owe $10,000 and you pay $10,001, you could owe $100,000 as long as you paid it by April 15th. You don't get an underestimation penalty. And so that's part of our calculation. The tax software typically calculates what the safe harbor is and says, what do you anticipate making next year? And you say, I don't know. We say, fine, we'll give you a safe harbor. If you think you're going to make less, then you're on your own because you can pay less, but if you're wrong, you're going to get an underestimation penalty. Underestimation penalties are purely an interest calculation. They're not a 5% per month penalty. So it's a 6% per year penalty, which for most people is like 45, 50 bucks. So it's not worth losing a lot of sleep over unless the number is really bad. But the most I've had on underestimation penalties, except for like real big wigs, is like $300 or $400 for an underestimation penalty. And that's because they tell me every year, you know, you told me to pay $4,000 for the state. I didn't do it. Why? Just because I didn't do it. I have no excuse. I just didn't feel like doing it. And they accept the penalty every year, you know. So, and the state used to let you get away with it. Now they're starting to hit you with underestimation penalties.
I can ask another.
You can ask anything.
Yeah, I realize that part of this question is really for an attorney. But if I own rental property,
Yes.
In my personal name,
Yes.
because I can't get a loan as an LLC, should I form an LLC to manage the property? Is there an advantage of?
You can. There's no such thing as not getting a loan in the name of the LLC, because no matter who you are, you're never going to get a loan in the name of the LLC. They're always going to ask you for a personal guarantee.
Okay.
So
theoretically, I could get a loan in the name
of the LLC,
but based on
and
my
it will
credit.
be correct, and it will be
Okay.
personally guaranteed by you.
So then the LLC could then own the property.
I would say the LLCs are nice from a legal perspective, especially on a rental property, where if somebody falls through the floor because of defective workmanship, from a legal liability viewpoint, the worst they can do is take the house.
Right. Is there a tax advantage?
There's no tax advantage. This is purely, and the whole concept of an LLC is a legal concept. And that's why I say an LLC is a legal concept. How it's taxed, pretty much on all four types, it's fairly similar. Okay, you're not really gaining some magic pill by being a sub S corp or whatever. If you pay your health insurance as an individual, as a partnership, or as an S corp, it's pretty much treated the same. If you're a corporation, you can deduct 100% of your health insurance. The problem is a corporation is much more complex. You can't just take money out of a corporation. You have to loan it to yourself. You have to loan it to yourself with a promissory note. In there, the bank loan has to be in the name of the corporation. You know, if you borrowed the money, it's considered an officer's loan, and you know, so there's a lot more complexity to an LLC. But in a partnership, if you want to pay your personal taxes out of a partnership, you just write a check, and I just charge it to the owner's draw - Pennsylvania.
Mm-hmm.
I like people to pay their taxes out of their company, because then at least I can see the check. You know, because a lot of times I don't know the source of funds, and they forget what bank account they wrote it out of, and they have no documentation for it, and it's the day before filing, and they say they'll look it up, you know, and they're calling you on the 14th and telling you what's going on. So everything I do is about documentation. It's just documentation and paperwork. And so, you know, the three earlier types of entities have basically the same type of tax aspects on them. The corporation's a little more complicated. It has net operating loss carry forwards, some other things. With an S corp, if you lose money, you can take those losses on your personal return. On a corporation, you pay taxes on your income. Your losses you carry forward till a year you make. You know, so there's a lot more complexity in a corporation. And there's also state taxes associated with all these entities. So there's a state sub S corp, there's state corporate taxes, et cetera. So, and in Philadelphia, it gets one more level where you have two types of taxes. You have BIRTs and you have net profits tax. And so I'm not going to get into it too much here, but a Schedule C, a partnership, a corporation, a sub S are all treated differently for the city. And if you make less than $75,000 or $100,000, sometimes you pay gross receipts, sometimes you don't. It's even if you make $25,000, you still have to fill out that same 18-page city return. And so I feel sorry for people that make very little income and are looking at that city tax return, even though they quote unquote have a EZ return that's only 4 pages.
The city tax?
Yes, you have to file city tax returns on your business.
What were the two? That was BIRT and
BIRT and NPT, net profits tax and business, I don't know, BIRT. I forget what it is.
Business income and receipts tax.
Yeah, business income and receipts tax. Yeah. So you pay on your gross receipts. Even if you make no money, you pay on the gross receipts. So when you ask people, why is their business located in Bala Kenwood, it's because their gross receipts for income earned outside the city are not taxed in the city. Unless, of course, you're a city resident, then all your income is taxed.
so
But for some reason, my sub-S corporation is located in Flourtown, and we have New York, Philadelphia, and Montgomery gross receipts, of which I only pay on Philadelphia gross receipts, and I pay on Philadelphia W-2 income for myself.
But if something like, Alex and I were talking about Philly tax benefits that you get as being a corporation here in Philly, which there currently is some, depending on who you are and what qualifications you fit into, you wouldn't qualify for those benefits.
There aren't any Philadelphia tax benefits. There's benefits to being a Philadelphia company, but there aren't a whole lot of offsetting type benefits.
Philadelphia there's no NPT on corporations.
Correct.
Right? So I assume S corps don't qualify? I mean, is there an advantage of being a corporation so you don't pay NPT, or is there just a corporate tax that replaces that?
There's a corporate, the corporation pays, on that. You still pay.
Yeah, it nets out pretty close.
Yeah. It's not worth enough to switch entities because they get you somewhere else.
Right, okay.
The sub-S corps and partnership net income is actually not taxable for gross receipts or net profits. And, it gets a little weird what qualifies and doesn't. And I'm sort of surprised sometimes. I don't understand how they got away with that one, and then you find out later on you pay somewhere else. So. But yeah, Philadelphia taxes are probably far more complicated than state taxes. It's just a flat tax. I mean, the Philadelphia taxes can really send a small business person for a loop because most people don't register their business. So technically you're supposed to register your business and have a city ID number so you can pay a city license so you can operate. And operating means just collecting money, and they consider you operating. If you're in Indy Hall, you're operating as a business, and your business address is Indy Hall. So you should file a $150 license fee to qualify as a Philadelphia business. And then, if you do any kind of employees, the employees work at Indy Hall, they're Philadelphia based. If they work in Flourtown, they're outside of Philadelphia, depending on whether they're a Philadelphia resident or a non-resident, and then that's why you want to have a payroll company deal with it, because if they're a Montgomery County resident and they're doing work in New York, their W-2 wages for that week are going to be different than if they're in Philadelphia as a non-resident. If you're a resident, it doesn't matter where you work, you're going to get taxed in Philadelphia. So the payroll companies do a fairly nice job of tracking that stuff for you, and if you have a good advisor, they talk you through this stuff. If you don't have an accountant, they can qualify as your accountant to handle a lot of these issues for you. Obviously, I like you going to your accountant, and usually the accountant recommends, and I really don't care who you use, whether it's ADP, Paychex, or Gusto, as long as you don't use me, because I do not do W-2s.
A question, like, if your business is registered outside the city, but
Okay.
you come to an office to do work, even though it's not the residence of the business, is it still taxed as you working in the
Well,
city?
according to Philadelphia tax law, if you do any business in Philadelphia, you are subject to any and all laws of the city of Philadelphia. So I had a Jenkintown business that did business in Philadelphia, a corporation. They had employees that lived in Philadelphia and forgot to adjust their W-2. And under a W-2 audit, they certified that these people were city residents because they own property in Philadelphia, and they didn't withhold Philadelphia wage tax from them. The corporation was liable for 100% of the wage tax, and they were responsible to get it back from the employee, even though the employee no longer worked for them 3 years ago, and they had no chance of getting the money back from the employee. So they ended up paying the 5% tax to Philadelphia because they did 5% of their business in Philadelphia. A Philadelphia audit is almost worse than an IRS audit because they don't do many of them. And so they figure they want to make it worth their time.
What does it mean to do business in Philadelphia?
You collect any money. If you collect a fee from anybody in Philadelphia, you have done business in Philadelphia.
And what
If you live in Philadelphia and you've collected money from anybody anywhere, you're doing business in Philadelphia. So either you operate in Philadelphia or you move into Philadelphia and transact business with a Philadelphia client. Now, if you do business with a Philadelphia client and they bring all the work to you, that's different. So if you don't come to their office to do their work and they just send you the work, you're doing the business outside the city. But if you're a city resident, anything you do is considered business inside the city. And so you should have a Philadelphia number, you should have a state number, you should have a federal EIN number.
We're also in like a weird limbo where all of these laws are written without taking into account people that may be here for some period of time without necessarily, like, where do you qualify living when you're paying a utility? Or like, what if I'm just passing through for the week? Or
if you're doing business in Philadelphia, irrespective of where you live,
right,
you have to either file as a resident or a non-resident. You're one or the other.
right.
There is no third category.
Well, that's my point, is like there is a reality now where people spend their entire working life traveling and they're not in one particular place.
And theoretically, they're supposed to file in every entity.
Right.
Look at a football player. A football player has to literally file in 50 states.
really?
Yes. If they play a game in Seattle, their wages are considered Seattle wages. That's why they make such a big deal out of the stadiums being in Camden or in Philadelphia, because all those professional athletes, the day they're working, the day they come in for the day before to sit there and do work, all their systems calculate where they've generated their income during the year. And so some of the big eight accounting firms don't exist anymore, but the big accounting firms used to have a client and they would have a partnership return and they would have 50 individual states for the K-1s. They would have one federal tax return and have 50 showing income being earned in all these various states. And it's becoming more and more complex, where I just got a request from California that I have a political group that does canvassing, where they go door to door. And they said that they did work in California, and they're a Pennsylvania corporation. And so we had to split out the gross receipts for California, and then we had to split out the payroll for California, and then we had to split out the rent for California. It's called the three-factor calculation, and they calculate how much of your payroll's in that state, how much of your rent is in that state, and how much of your gross receipts is in that state. And then you have to fill out their 18-page tax form that you've never done before. And thank God for computer software. And even with that, it's difficult to file. So I ended up filing for 10 different states for this quote unquote simple corporate tax return that they told me was a piece of cake. And so I ended up, picking up, there is no such thing as a simple return anymore.
So like a QuickBooks or something like that would help make
Quick-
this a little bit easier.
If you record QuickBooks the right way,
Okay.
if you use what's called books of original entry, it's an accounting concept, accounts receivable, accounts payable. Small businesses typically record cash basis. I receive a check, I put it in the bank, that's it. How much money did you make last year? $250,000. Who did you receive it from? A lot of people. If you have accounts receivable, you say, here's my cash receipts, here's all my stuff, here's all my states, and I can give you that calculation, in which I get this much from this state, that much from this state. And then you have to use a materiality concept that you've received. I had this startup company, and we're trying to do things the right way, and so I'm filing in California for $2,700 on $1.6 million, but they're going public at some point, so they want to do things according. Does everyone know what GAAP is? Generally accepted accounting principles. So they have to do things according to GAAP. And according to GAAP, you're supposed to do all the tax laws, et cetera. So even though there's small increments on each individual state, we're filing on all these states, and it's just really creating a headache. But they brought in a couple $1 million of investors, and they're trying to get things done the right way. And they have a runway of X number of months, and all this startup stuff, and it gets a little crazy. We don't do audits, so we don't do that upper level stuff. We do their internal accounting. We pay their bills and keep track of everything. They have their own accountants in-house to pay bills, but we're their intermediate service, where we try to track deferred revenue, all their taxes. They're a Delaware corporation because they're going to file all over the place. They have a brewery up in Connecticut. They're based in New York. They do work in California, so it gets fairly complicated. And all those kind of things are all allocations. That's really where things get complicated. If you do most of your stuff in Philadelphia, you file in Pennsylvania, Philadelphia, New York, that's what I call a simple return. Go ahead.
I have another question, but it's probably new. I'm not sure if it's touched on it much. If corporation invests into something like a cryptocurrency.
Into what? Oh, I know nothing.
Okay.
There's no. The IRS is spending most of their new money on trying to figure out what's going on in cryptocurrencies.
So it's just
Somebody just asked me, I have 5. What's the latest guy that's making money? Bitcoin. I have 5 Bitcoins. If I sell them, do I need to report them? I said, I'm not going to answer that on the phone. You need to do what you think is right. The IRS is not getting, they do not have a reporting mechanism in which that currency is reported to the IRS, and that really annoys the hell out of them. So yes, the law says you need to report any and all income you earn. So yes, you need to report your cost basis on those Bitcoins. You need to report the revenue you received on them.
Maybe I have a question just on asset value. The value of an asset you buy, no matter what it is, it goes up and down, or it's in flux.
Right.
If you are holding it like you would a share of some sort, say it hasn't gained much income, very little.
Right.
When is the point at which you have to?
When you realize you're on the cash basis. As an individual, you all operate on the cash basis, meaning if you receive cash for it, you report it. Okay?
But if you bought it, it's not receiving.
No. If you receive cash, you report that revenue, and if you paid cash, that's your cost basis. That's a simple answer. More complicated answer is what you were asking is market value of stock is considered unrealized gain. Right? If you look at any kind of brokerage statements, they give you a brokerage statement, they show you the realized gain and the unrealized gain. They show you a special tax section that says taxable income. You might have $2,000 worth of taxable income and have $10,000 of untaxed income, which is unrealized gain. So
Do you have to report that unrealized gain?
no, they give you a 1099 interest and dividend that reports it on the cash basis.
Oh,
Okay, so let's say you owned AT&T stock and they report a dividend on December 30th. That's considered income for the realized basis, unrealized basis. You receive that dividend check in January. You pick up the income in January. The market value of that stock is realized and unrealized, and your brokerage statements do a very poor job of keeping track of the two of them. Because I had one client that has 35 of them, and I thought I could sit there and track them all. And I gave up after a while because they had K1s and they had stuff rolling in and out, and it just can get very complicated and very difficult to track the differences. But all you report on your income is what you get on a 1099. All brokerage companies, those guys all have major tax departments that track all that stuff for you. And they'll give you a 1099 interest dividend, and they'll give you a 1099B, which is the sale of the stock. And if you use a broker, you should always report to the broker when you give them the stock what you bought it for. So that way they can put the cost basis on their books. And when they give you a 1099B, they can say, we sold $1,000 worth of shares and you bought it for $500. Makes it real simple for your tax accounting.
Yeah.
Otherwise, you have to prove how much you bought it for, when you bought it. And there's a whole process.
Yeah.
Where you told me you bought it in 1955 from your Uncle Louis, he bought it and he gave it to you. And so we just say, we go back and look at the books and find out AT&T stock in 1955 had an average cost basis of this. And we do our best guess estimate, because if we can't do a better job, the IRS can't do much better, because they don't know when you bought it in those days.
What about the exchanges when they exchange it from one share to another share? So it never becomes real cash. It just gets converted, and there's a conversion fee.
That's a stock split,
Okay.
I think, that you're talking about. And a stock split, if it's done within a corporate and within a brokerage account, they track the accounting. Basically, a lot of times you may get a stock dividend. The cost basis may be zero. You might actually receive what they call phantom income. You might receive a dividend, reinvested dividends are phantom income. You receive $1,000 worth of dividends, they buy $1,000 worth of stock, you get $1,000 more in stock, you get a 1099 for $1,000, and you got to pay tax on it. You say, but I didn't receive anything. And they say, yes, you did. You received stock for it. You can sell that stock to pay the tax if you want.
Okay. So transferring between shares could end up making the situation worse.
There's all kinds of stuff.
Even if they're charging a fee for that transfer of
the fee is
conversion.
deductible.
Right. But the fee is minuscule compared to, if you're transferring $5,000 to another thing that.
Well, transferring isn't a technical term. What you're doing is buying and selling stocks. You're creating taxable transactions. You sold one and you bought another. You haven't transferred it. You've exchanged one for the other. If I exchange my car and you give me your motorcycle, I've sold you my car and you've sold me your motorcycle. They're taxable transactions.
Okay.
Everything's a taxable transaction. Oh yeah, everything's, once you get into there, everything is a taxable transaction. It's whether you pay tax on it or not is a different story. Where you don't want to get to, they even have a term for it, phantom income. You don't want to have phantom income because that means you have to report taxes and you've received nothing for it. Capital gains on mutual funds are what they call phantom income. They distribute all this money at the very end so they can create a capital gain, and you don't really see much on you, but all of a sudden you have this huge capital gain on on your muni fund, you have to sell some of your fund to pay the tax on it. Yeah, none of this stuff's all that simple.
It's also situational.
Yeah. Yeah, like sometimes even when you transfer it, let's say there's good transfers. Let's say you have some artwork and it's worth $10,000. You bought it for $1,000. If you sell it for $10,000 and give it to a nonprofit, you get a $10,000 deduction, but you pay $9,000 of gain on the sale of the artwork. Or you could give the artwork to the nonprofit and you get a $10,000 deduction and you don't report the gain. So it's like a win-win situation. So that's, nonprofits tell you, if you've ever heard of a nonprofit, they contribute appreciated property to us. That's why they do it. You don't have to pay on the appreciation on that property. If you sold it and gave them the cash, you'd have to pay tax on it.
I have a question, because I know we spoke earlier. I don't know if we spoke about this before or the beginning of the thing. Anyway, so you tried to maybe answer this, but are there guiding principles for deductions? Like what you can write off? Because I know, so you were saying to me, like, if you go, if I have an LLC in New York City, I can write off much.
Okay.
Over there.
So,
and I guess the second part of the question is like, if I don't have the receipt for the Wendy's that I went to, but I paid with my credit card, could I?
well, the first answer is it doesn't matter who you are, whether you're an individual, partnership, corporation. The deductibility rules are still the same. Okay? And documentation is everything. Now, just because you ate somewhere doesn't mean it's deductible. So let's say you go to New York and you stay there for 2 weeks. You went to see somebody one day and you stay there the rest of the week. That one day, if you had lunch with that individual, just getting a receipt for the Capitol Grill for $1,000 for that meal is not sufficient. You have to say, I went to the Capitol Grill with Jose and I went there to discuss taxes or the new tax planning for whatever. So you need to include the receipt, some kind of positive receipt, and you're right, the credit card would be a great way to do it. Once again, there's other apps that are out there, something called Expensify. You literally take a snapshot of the expense. It will sit there and store it in their database. It will sit there and identify it at the end of the month, at the end of the year. It'll sit there and summarize it for you. It'll even post it to QuickBooks for you. Okay, so there's apps out there that do that kind of expense analysis. There's apps out there that do mileage, which I just saw on TV, which I think is real BS. It's how hard it is to keep track of mileage, but they say, they'll save you all this money for mileage or whatever. But if you're doing something to help your business, you pretty much can deduct it. Now, going to Wendy's, I wouldn't be real keen on that one, okay? But if you're going to New York, one of the things I spoke with somebody is you really should look at per diem rates. Per diem rates for cities, they have an IRS publication on it. If you're going to New York and you're having meals, you might be able to take a per diem deduction for the days you're there. It's a lot easier for you to prove that you were there for the day. And you can say you were in New York for 16 days and you take your per diem allowance. If you were there 16 days and you stayed overnight, you can take a lodging per diem. In New York, it's a lot more expensive than per diem for York. I had somebody who went to Paris, France for 4 months. He made out far better on a per diem in Paris than he would have on his deductions, especially because he stayed with the owner of the company half the time. It's called safe harbor. You're allowed to just take the deduction, just like you're allowed to take mileage at 52 cents a mile, whether you have a brand new Mercedes or you have, as my son has, a 94 Saturn. He worked for an engineering firm. My wife hated him driving the car, but he said he'll drive it till it falls apart. And he would drive to Albany, New York, 3-4 times a month. And it was pure money for him. He said he gets 35 miles to the gallon, and he got 52 cents a mile for it. You don't have to report that on your personal tax return. That's called employee and mileage reimbursement. The company can deduct that 100% of that as a deduction. You don't have to pick it up as income. It's just reimbursement of expenses for you. So there's a lot of ways, and there's lots of publications out there that say what you can deduct. But essentially, if it's for the furtherance of your business, you can deduct it. All your Indy Hall expenses are deductible. The candy machine, maybe not, okay? But if there was an additional fee for like an event fee, and it was paid to Indy Hall, it would be a deductible expense, okay? You buy a computer, you buy paper, you go to Staples, you go to Best Buy, you buy a computer, you can expense the entire computer. If you go out to dinner with somebody, you can deduct 100% of it, but only 50% of it's deductible if you document it. But basically anything you can, now let's say work clothes. Work clothes is a real bogus thing. Because some people used to say, well, I got to dress up in a suit. And they said, well, if your suit says Lanyap Financial Services in a label, and you really would be embarrassed to wear that anywhere else, you can deduct it. But if it's a blue jeans that you wear to the oil refinery and they're clogged with oil, the IRS has come back and said you could wear that oil-filled blue jeans somewhere else and they don't deduct it. If you have a brand new pair of $200 steel-tip shoes, you can deduct them no matter how beautiful they are. But if you have a pair of old work boots that you can wear in the garden, they're not deductible. So there's
There's a gray area.
it's not that gray an area. Basically, I just tell people, unless you're, why do you think people have all these golf shirts with names on them? Because they go to a golf shirt company that says, you can buy 200 of these in all various colors, and we'll put your name on every one of these, and we'll put Donald Trump on your sleeve here, and he probably deducts it, Not good political.
What if you're like a tech company and you have to wear a tech shirt, otherwise other techies won't respect you, and then you can't.
What's your tech shirt say? Does it say techshirt.com?
No, but it's something related to tech, so it's in general it gives you a
if it says Novell for those old guys, anybody know who Novell is?
Yep.
Novell's the old network, okay? I had my Novell bag that I got at some computer seminar, That would be a deductible expense for them.
So, let's say I'm talking to somebody here in your hall, and then we're like, hey, that seems like a good idea. Let's go out and grab a couple beers. Talk about it.
That would be his gray area. Because do you ever go have beers with them when you're not talking business? And have you fully documented the business you're talking about? Now, if you're taking me out to lunch, and I heartily approve of everyone taking me out to lunch and talking taxes, you can deduct it, okay? Because it's a unique situation that you're trying to do something. If you go out to lunch with the same people every single day, you're not going to be able to deduct it.
Would a calendar event invite and sign off, would that help build criteria for a business meeting? Like if it's a business meeting with John and Jess?
Yeah, I mean, but if you do it every single day, it's just a matter of bulls, pigs and bulls, pigs and whatever that expression is. You can be greedy to a certain point. If you take anything to the extreme, it's not going to work. But they're just going to ask for documentation and a reasonableness of something. But yeah, if it's a matter of you're taking, like if I took that guy out to lunch, he's my client, I would show that he's my client. And yes, we meet once a month to discuss his business. I mean, I have some lawyers that have $100,000 worth of T&E, and they never eat at home. They make sure Their secretaries document who they're going to lunch with, who they're going to dinner with. It's all fully documented, and they write off $100,000 worth of T&E, and the IRS has come in and audits them, and they're fully documented. They can't do anything about it because that is their business. They're a lobbyist. All they do is take people out. If what you do is you're taking out investors or doing something, it's all deductible if there's a legitimate business reason. The reality is there is no real gray area in expenses because most people know what's really a business and what they're trying to skate on. If you're wondering if you're skating on it, you probably shouldn't take it. If you have an uneasy feeling on it, somebody else will too.
What about like home offices?
Home offices are real interesting.
Specifically though, in a case with like girls or call.
Doesn't matter. Everybody can have a home office, but do you know the rules for a home
You're subject
office?
to building code.
No, not a building code. A home office is an exclusive area for your home office that is not used for anything else by anyone else in the house. So if your kid uses it as a playroom when you're not there, it's not a home office.
What if it's not a separate room, but it's like separated by a shelf and it's that corner?
If let's say you're single and you have a studio apartment and your business is, you get on there every morning and you check your email and you work at night and you have a specific area, yes, you can take it. Now, you have to calculate the square footage of that office area over the total area times a number. There's something called the simplified home office expense. Now they allow you $5 a foot for that. And that's the easiest thing. Always go for the simple stuff. When you try to make it too complicated and people try to take their real estate taxes and their interest deduction and depreciation on the house and all kinds of stuff, it doesn't work out because the IRS has figured out a way to screw you on the back end of this. If you've taken a home deduction for a third of your house for the last 20 years, when you sell your house, you have to pay on a third of your house capital gain where it would have been 100% excluded. They're going to come back and ask you for the 1/3. If you take the simple one, you don't have to do it, They're just coming after the people that were being real greedy and trying to take all those expenses and take them too far. And I'm just like, I'm a conservative guy. It's like, if I don't want to do it for myself, I'm probably not going to want to do it for you. Because if you're wondering whether it's going to get through audit, then that means in your gut it's a shady deduction.
I tried doing it once, and they also subjected me to building code where I had to meet fire and safety standards for that area and that space. And I had to provide a fire extinguisher and fire.
But that's if you wanted to, that's not a home office. That's an office in a home. That's a business in a home, which is different than a home office deduction. Home office deduction is just you put a desk somewhere. Home office deduction is an IRS deduction. What you're talking about is putting a shingle and having people come visit you at your house and running your business out of your home. That's a zoning.
I had no one coming to the home. It was just to do work in the home. And in order to register, they wouldn't let me do it without proper parking, all of these things.
Right, but who were you registering with and why were you registering?
It was a local township, and it was so I could have a registered business in that township and be able to show that I live and the business operates here. I ended up becoming a mobile office in my work truck, and that became my new office. And then never having a registered business other than
which is a good reason to have an Indy Hall address.
Yeah. And then I came here.
Yeah.
To get back to the question I think you were asking was, can you deduct Indy Hall membership and home office at the same time?
Absolutely.
Okay. So,
but I would take the simple home deduction because your workday, if you're self-employed, is from when you wake up to when you go to bed. Typically, you wake up and you check your email and check what's going on things, and sometimes you go to bed when you're so tired you can't work anymore.
Yeah.
That's what a small business person is. So yes, your home office deduction is definitely a deduction. When you come in here, it's a deduction.
And then I have not done my taxes for last sure. And I was planning to put Indy Hall stuff under rent or lease other business property.
Yeah,
That's what I've done in the
rent
past.
would be fine,
So-
yeah. Because it's not a club. We're not a club. It's not a subscription. It's really rent. You're renting a desk. You're renting electricity. You're renting a printer. So it's an office rent situation, and it could be classified as something else. The IRS could care less if it's category A versus category B. It's fully 100% deductible. Anything else about anything? Guys definitely have gotten away from the simple though.
Thank you.
Yeah, thank you so much.
Thank you.
Answering all these questions.
We'll have the video up on YouTube, so
Okay.
we can share that out with folks that came late, folks that couldn't make it, and you can have it if there's other people that
Okay.
want to dig in. So
Okay.
cool.
And if anybody wants the new tax rates, I have them here for single and married, and all stuff about LLCs.
Yeah.
And I put them on Slack.